London's first invisible market. It operated without stalls, without signs, without a single physical location. No bell announced its opening. No ledger recorded its full size. Yet this market quietly reshaped London's economy, moving fortunes through the city without ever being seen. It was the first market built not on goods, but on expectations. London had always traded visibly. Cargo unloaded at docks. Prices shouted across exchanges. Wealth could be pointed to, weighed, and counted. But as finance grew more sophisticated, something subtle changed. Traders began buying and selling not what existed, but what might exist. Value drifted away from objects and toward possibility. To understand why this mattered, we must return to a moment when commerce outpaced certainty. Ships were still weeks away. Harvests were still uncut. Political decisions were still undecided. Yet capital could not wait. Merchants needed ways to act before outcomes were known. Waiting meant losing advantage. The reveal emerged in private agreements struck far from public view. Promises to deliver goods later. Commitments to pay based on future prices. Arrangements that allowed risk to change hands before reality arrived. These trades did not require a physical meeting place. They required trust, timing, and shared belief. Slowly, these agreements formed a market without walls. Prices adjusted not to supply, but to anticipation. News mattered less than interpretation. A rumor could move value. Silence could freeze it. The market existed wherever expectations met capital. What made it powerful was its invisibility. Outsiders saw stability. Insiders felt motion. Value shifted beneath the surface of London's visible economy, shaping decisions long before goods appeared or money changed hands. Control moved to those who understood not what was happening, but what others believed would happen. London had created a market that could not be regulated by sight alone. It required insight, discipline, and restraint. And as it grew, it would challenge every assumption the city held about transparency, fairness, and control. The invisible market was no longer a curiosity. It was becoming the engine of modern finance. As the invisible market expanded, its influence began seeping into every corner of London's economy. Decisions were made earlier. Prices adjusted faster. Outcomes shifted before physical events could confirm them. Those inside the market felt empowered. Those outside sensed something slipping beyond their grasp. What made this market distinct was its reliance on belief rather than proof. Agreements were honored not because goods had moved, but because participants trusted that they would. This trust created speed, but also created vulnerability. If confidence wavered, the market could unravel without warning. Specialists emerged who focused exclusively on expectations. They tracked political whispers, shipping delays, weather patterns, and diplomatic moods. Their skill lay not in certainty, but in probability. They positioned themselves ahead of consensus, buying or selling promises before others recognized their value. Success depended on perception more than production. Tension grew as traditional traders struggled to compete. They dealt in tangible goods, bound by physical limits. Invisible market participants faced none. They could reposition instantly, amplifying gains while avoiding losses. The gap widened between those trading reality and those trading anticipation. Officials noticed distortions but struggled to respond. No clear location existed to regulate. No inventory could be inspected. The market left no obvious footprint. Its transactions were scattered across contracts, letters, and verbal commitments. Authority, accustomed to visibility, lagged behind. Conflict sharpened when invisible market swings began affecting visible outcomes. Financing dried up for projects still sound. Prices collapsed before goods arrived. Merchants blamed speculation. Speculators blamed information. Each side accused the other of destabilizing the city. The market's power peaked during moments of uncertainty. War rumors, succession questions, trade disruptions. Anticipation moved faster than fact. Decisions based on belief shaped reality itself. London was no longer reacting to events. It was preempting them. The invisible market had crossed a threshold. It no longer reflected the economy. It influenced it. And as dependence grew, the city approached a moment where belief would be tested, and where unseen trades could trigger very real consequences. The strain became visible when belief and reality finally diverged. Expectations race ahead, pricing outcomes that had not yet occurred, and in some cases, never would. The invisible market grew confident in its own signals, reinforcing patterns that fed on themselves. Prices moved because they were expected to move. Confidence persisted because confidence itself had become the commodity. The first fractures appeared when anticipated events failed to materialize. A conflict delayed but never erupted. A shipment rumored loss arrived intact. A political decision stalled. Each mismatch forced rapid reversals. Positions unwound. Promises were renegotiated. Losses cascaded not because fundamentals collapsed, but because belief shifted abruptly. Participants scrambled to adjust, but speed became the enemy. The same velocity that once delivered advantage now amplified error. Traders rushed to exit positions simultaneously. Liquidity vanished. Prices overshot in both directions. The invisible market revealed its fragility. When everyone trades expectation, there is no anchor. Merchants on the visible side felt blindsided. Projects lost financing without warning. Prices collapsed before goods reached market. They accuse the invisible market of distorting reality, of creating volatility divorced from production. Speculators countered that they merely reflected information faster than others could process it. Both were right, and both were exposed. Officials attempted to intervene, but found little to grasp. There was no exchange to close, no warehouse to inspect. The market existed across agreements and understandings that dissolved as quickly as they formed. Authorities struggled to slow something that had no physical form. The conflict sharpened when a major expectation trade failed spectacularly. Its collapse rippled outward, forcing settlements that drained capital from unrelated ventures. Confidence faltered not in a single sector, but across the city. The invisible market had become systemic. London faced a hard realization. A market built on belief can accelerate coordination, but it can also synchronize panic. When expectations align too tightly, correction becomes collapse. The city now stood at a critical moment. Either belief would be re-anchored to structure, or the invisible market would continue amplifying instability beyond anyone's control. The resolution came through constraint rather than suppression. London recognized that the invisible market could not be eliminated. It was too useful, too deeply woven into modern finance. But it could be bounded. Expectations needed anchors. Belief needed friction. New standards emerged requiring clearer disclosure of forward commitments. Limits were placed on how far anticipation could outrun verification. Contracts were standardized to reduce cascading reversals. The market remained fast, but not unmoored. Institutions adapted by blending visible and invisible logic. Financing decisions considered both expectation and physical progress. Risk assessments weighed probability against tangible evidence. Traders learned to respect delay as information rather than weakness. Confidence returned gradually, not the exuberant confidence of unchecked belief, but a disciplined trust grounded in structure. The invisible market continued to exist, but no longer operated in isolation. It became part of a broader system rather than a hidden engine. London learned something essential. Markets built on belief require boundaries just as physical markets require walls. Without them, speed becomes instability. With them, anticipation becomes insight. The invisible market did not disappear. It matured, and in doing so, it reshaped how London understood value. Not as something that exists or does not, but as something negotiated between expectation and reality. Subscribe to join the journey. London